Very good day wherever you're watching us from. This is Smart 24 TV, where we drive your business, and I hope you're having yourselves a wonderful day so far. It is the 12th of September 2022, and of course we are winding up almost coming to the end of the third quarter of the year. I hope you've had yourself some wonderful weekend just a few hours ago, and of course I hope now you're ready for a new week of work, a new week of investments, and making ourselves better in terms of savings and investments. My name is Anthony, and you can follow the show on Twitter. That is at Smart24TV. Hashtag is Financial Markets. You can also watch us live on our YouTube live stream on Smart24TV Live. And you can as well catch us on GoTV, channel 394, and now on DSTV as well, channel 372. I thank you very much for joining us this morning. We are very glad to have you. And now sit back and, of course, get informed of what's been happening in the financial markets world around East Africa. This show is entirely about saving and investing, and we have a goal to see that Ugandans can get to save more money, Ugandans can get to make more money using their residual incomes, as well as using on some of their savings. And the financial markets give you a perfect opportunity to do this. Many people start businesses, many people get into several trades, and some people get into cryptocurrency, some people get into forex trading. Now, well, financial markets is a little bit more of what people do in the trading world, but it's a little bit different because, first of all, unlike the other maybe kinds of trading like forex and cryptocurrency, the financial markets are regulated, and they are well regulated. They have rules that people have to follow, and definitely there are several players, including the government, that are, of course, around the space of financial markets. And so what we try to bring out is the fact that most people in Uganda have not yet realized, with only about, for example, 0.1% of Ugandans have been able to invest so far in the stock exchange or within the stocks or the stock market. That is over about 180,000 out of over the 45 million Ugandans that we have. And so this show is going to be able to bring you information regarding the stock market performances, regarding the bond market performances, regarding reports from the stock exchanges around East Africa. And we break down and analyze these performances for you to easily understand and make informed decisions. Like I said already, the lack of investment that we are looking at is due to the fact that people are not aware. People are still ignorant, at least from a wider perspective, on what financial markets really are and how people can get started on their investment journey. But on a Monday like this one, we usually want to break it down for you, and so we can get started on the same footing. Now, when we look at these markets, we're looking at four main segments. That's generally speaking. We have the stock market. This is number one of the most common financial markets that we know of. That is investment within companies that are listed on an official stock exchange, such as the Uganda Securities Exchange, the Nairobi Securities Exchange, and the Dar es Salaam Stock Exchange, as well as the Rwanda Stock Exchange here in East Africa. So that is one segment, and we will break it down a little bit more later on. The other segment is the bond market, or the debt market. And in the debt market, we are looking at borrowing and lending. Who is borrowing? We have two bodies mainly, the corporate bodies and the government. Borrowing from the public a given amount of money for a specific period of time and returning that money with interest. back to the investors. And then we have the other product called the derivatives. Now, the derivatives are kind of derived from the other two products. Let me first mention the commodities before we go on to the derivatives. The commodities is the third product we have. Now, in Uganda, this is still yet to come, and the exchange is working day and night to see that we have a commodities market on the exchange. But when we look at other stock exchanges, such as the New York Stock Exchange, you look at Shanghai and so many others, they have commodities that are listed on the stock exchange. In particular, we look at precious metals, we look at some crude oil and other fossil fuels maybe, and some of the other products that could be listed on an exchange for trading. Now, because of volatility in prices and so many other things surrounding the prices of these particular commodities, the exchange could list some of them in order for investors, in order for buyers and sellers to be able to find a common market where they can be able to trade and be able to buy and sell at a particular price. This is known as the commodities market. And that's the other segment we look at and under the financial markets. The other segment is the derivatives. Now, derivatives, like the name goes, these are derived products, derived from the other three products we have already mentioned: the stock market, the debt market, and the commodities market. They are specialized products. They're kind of bets on which people put money. Of course, investors put money. Of course, these are a little bit more complicated and might require more insight from experts, but these are also derived from the other three markets or products that we are looking at under financial markets. Of course, these are some, but these are the most common parts of financial markets, but not limited to these four, because financial markets grow with time, and they are segmented depending on which perspective, under which perspective you're looking at things. If you're looking at maybe you're looking at the period of maturity, you can still break down financial markets further. If you're looking at the nature of the claim, you can still break them down a little bit further, and so on and so forth. So these are some of the generalized markets that we look at here on the show. And why are these markets important? As of course, we're going to break them down and see each of them and how important they are. These markets give us an opportunity to make use of money, to get more money. Because money, whenever it's not in use, whenever it is stored without being actually put into use, that money loses value with time. That is economics definitely telling us so, that we don't have to keep money on ourselves without putting it into circulation, putting it into the money system, where we're seeing money doing things. And so they give you an opportunity to see that your money does something. And that's why in the financial markets, we look at mainly getting to invest within financial markets using our residual income, or using that money we are not going to need, at least within a very specific period of time. And so they are kind of a way of earning passively. If you want to know how to make money passively, this is the way to go. And they're not just for rich people or people with billions of money. They're for people like you and me, common people who are willing to put away money for some period of time and see that money gain value, see that money grow, see that money get you some more money. And so if you're one of those people, you should be watching this show, and definitely you should be catching it every weekday, Monday to Friday, so where we will be giving you a breakdown of what these markets are like here in East Africa. Of course, we are interested in other markets as well, but we would want to grow our own markets here in Uganda and within East Africa first, and then we can probably go and expand to others. And It's a very simple way of participating. You have your business, you have your personal source of income, your job, you're a trader, you are a rider, border rider, you are a driver, you are an engineer, a lawyer. It doesn't matter what really your source of income is. Of course, you must have one because you need money to invest in the markets. You need money to be able to put aside and make these investments. So that is number one. And when you have that, you can still make yourself a plan, an investment plan, and look at the portfolio that you would want to have in the next maybe, let's say, 1 or 2 years. You have to set yourself a goal. Where do you want to see your money? How do you want to see your money grow? Where do you want to invest most? What are your likes? What are your dislikes? And such a thing. So you also look at your personal interest as an individual and evaluate yourself depending on how much you're willing to put aside and also where do you want to see yourself in the near future. Now, the stock market works in a very, very simple way. And I've broken down this before, but I always want to get to repeat. We could have some probably new viewers every now and then. And of course, you as an old viewer, you might also need to get reminded. Now, the stock market is a very simple market. You have a market where companies that are looking for capital meet investors that are willing to invest in these companies. So if you have, for example, MTN, that is the most recent company that has been listed on the exchange, it's looking, of course, to maybe set up more masts around Uganda, maybe increase its technological advancement within the sector, trying to see that they ease the way people access their services. And probably they need more money than what they have right now, or that exceeds their income right now. What they will do in particular is they will come to the exchange and they'll go through a specific scrutiny. And this scrutiny is, of course, to make sure the company is authentic, they're dealing within legit products, and that the company should have well-audited books, at least within the recent past 3 years, and so many other rules that, of course, they have to see and be able to observe. They have to issue what we call a prospectus, which indicates the number of shares that the company is going to trade to the public, and so many other things. And when they pass through this and they're able to succeed, they go on to what we call an IPO, the initial public offer. Initial public offer is simply the first time the company is coming to the public to seek capital. And meaning, how is it going to get this capital? It's going to give away part of their company to what we call shareholders, which are the investors, which is you and me now in the public. And giving away this part, it's going to come at a cost. That initial cost is what we call a share price. And the share price is the price at which the person who is seeking ownership within a company is supposed to buy 1 unit of ownership. So for 1 unit, you have a share price, which is the price of a share. And when people are buying for the first time, it's for a specific period of time. It doesn't last forever. And we call it the primary market. Primary because you're buying directly from the company. You're buying shares from the issuer, who is the company, coming to list on the exchange. And we saw this last year, of course, in December 2021. Now, immediately these companies have gained, at least at the period of the initial public offer is over. If the company has been able to sell out all its shares, well and good. If it hasn't, those that have not been sold out are taken back into the company. And now, what happens after the primary market? Now, this is the most important part. After the primary market, we go on to the secondary market, where the listed shares, the bought shares by these shareholders who bought for the first time, are now listed on the main board of the exchange. We're looking at the second time of listing. Already bought shares are now listed once again on the exchange. Why are they listed again? We keep exchanging these funds because That's the way the company grows. That is the way the share price grows. That's the way investors gain value, by being able to transact these shares or being able to transact these instruments from one person to another. And so this secondary market lasts as long as the company is listed on the exchange. And as long as we have this listing, the company is able to be bought into by new shareholders, and the old shareholders are also able to sell to the new or incoming shareholders. Also, the old shareholders, of course, can buy from other old shareholders in the company. And so this happens every single day, Monday to Friday, on the exchange. And it happens from 9 a.m. to 12 p.m. Sorry, to 1 p.m. in Uganda. And the several companies, of course, are listed, 18 of them here in Uganda. And amongst these 18, 10 of these are domestic companies here in Uganda. They're domestically, some of them domestically founded, others domestically present within the borders of Uganda. And these companies have been listed, some of them for a year, others for over 20 years, and of course, so many others. But the main thing I wanted to bring out here is that you have companies seeking capital, and now shareholders buying into these companies. Now, how do you and I, who have been able to buy shares into a company, benefit? There's several benefits, but I will just highlight a few which are very common. Number one is the dividend. Every time a company that is listed on the exchange registers a profit, there is a kind of anticipation that the company should give back to some of its shareholders. And this is not a must, however, but companies must find a way of giving value or adding value to their shareholders. And one way they do it is through issuing a dividend. This is just a fraction of the net profit of the company that is given back to its shareholders as a kind of token for them to take out of the company. Because the company has been able to register these profits because definitely there have been investors that have trusted this company with money. And so that still is one way companies are able to add value to their shareholders or to you and I as an investor. The second way is through sometimes what we call a bonus issue or a rights issue. A bonus issue is where we're having extra shares issued to shareholders. And these extra shares come at absolutely no cost for all the shareholders. Usually this happens when the company is not going to issue a dividend. And so it decides that, hey, for every single share you have, we're going to add you 2 more shares. Yes? The most recent company to do that has been National Insurance Corporation. They issued over 7 million bonus shares to their current shareholders. And so the next time the company is going to declare a dividend, you will find that these shareholders will actually have more of the dividend than other shareholders who might not have been able to benefit from the bonus issue. The rights issue is also within the same perspective. However, the rights issue is coming at a specific cost, where we're seeing companies issuing some extra shares for only their shareholders at a specific cost, sometimes even subsidized cost. And so those are some of the channels that you can gain from. But another channel, of course, is the capital gain. Just like you go in Nakasero market, you find people trading tomatoes, but they don't grow them in Nakasero. Some of them buy them from villages and bring them to the market, and this way they buy at a lower price and sell at a higher price. That's another way of gaining. So you have people buying shares at a lower price, and then they look at selling them at a much higher price. That is another way, what we call the capital gain. And so those are some of the angles in which people are able to gain from the stock market. And if you want to trade on the stock market, you cannot buy directly. You cannot go to the exchange and say, hey, I want to buy shares in MTN. You have to go through what we call a stock broker. And this stock broker is supposed to be licensed by the Capital Markets Authority. And when they are licensed, they are given the mandate to be able to intermediate or to mediate between you and the exchange and also the company into which you're buying shares. So these stockbrokers in Uganda, there are several of them. We have SBG, we have Crested Capital, Dyer and Blair, and UAP Old Mutual. These are the licensed, and of course the new entrant, that is Cheaper Technologies, stockbroker. So all these are here to help you get to buy shares on the stock market. When you buy, of course, be very vigilant. You don't want to buy today and sell tomorrow. The stock market is really a patient capital reserve, and you're looking at patient capital. You must be patient enough and wait for some period of time to see that you benefit from the stock market. You don't want to lose all your money in a single day, because there are risks, of course. There are times companies will perform so poorly, there are times companies will perform so well. And so you must be very vigilant while investing. That's an overview of what we look at here as of course, financial markets analysts. And we bring experts, of course, sometimes to bring us some more extra content from the regulators, from the stockbrokers, and so many other things. All you have to do is stay tuned and get to learn more. Now, of course, there are other ways that I've not mentioned, maybe that people can benefit from this, but we shall keep sharing, of course, as we move forward. We're going to take a quick breather, and when we return, we are also still going to break down the bond market or the debt market, and then walk straight into the stock market performance for last Friday.